got it. We got some conference call. We're going to go through, see exactly what their guidance is, what things that they're going to say. As you can see, I got the lovely bullish mindset with me. Links to his YouTube and Twitter are in the description below, but it's going to be a very exciting earnings. They did clearly, so there's going to be roughly about 10 minutes before the actual conference call. In that time, we're going to go through some things that did, obviously they had their leaked earnings. There's a lot of things that is coming out saying that that was unexpected, not necessarily. It seems like a lot of, I think in general, SoFi is very heavily manipulated, so people are taking that as a negative. But on a side note, making sure you guys hit that thumbs up and subscribe and do all that fun stuff. I greatly appreciate that. Also, let us know about the audio, if you can hear, if you can't, whatever it might be. And if you guys have any questions for either of us, put it in the comments. Appreciate you joining Bullish Mindset.
Yeah, thanks for having me. Let's talk about some SoFi, which formerly IPO, come out off TSPAC. But I honestly love this company. Innovative, disruptive. Huge upside. But it's everything on the market's getting destroyed right now. So I'm gonna be picking up these deals.
Love this stock. I've been investing for a while, and I've actually never seen a stock that has so much potential that even on the recent earnings shows fairly strong ability to grow, but yet it's like, man, Wall Street just hates it. It is manipulated so bad. It's crazy.
I think that, and I don't know if this is going to be controversial, but the banks don't want SoFi to succeed, and we're ran by a market very fueled by institutions that want to destroy innovation and disruption right now. SoFi is not going to be able to stay down for long. They have Galileo, Technisys, acquisitions. They have the Zelle integration. It says Echo. Yeah. You have an Echo bullish mindset?
Yeah, I fixed that already.
Okay, cool. And I honestly think that with the crypto as well going into their platform, there is so much for SoFi to gain a lot of these users on their app. It's only going to increase. I think that they gained 480,000 members during Q1 as well. So we're going to continue to see upside with this company. It's just, when is the market going to understand it? None of us are. I really don't think that all of us are wrong. But I think that we're going to get some good indication on what the growth is going to be. And I love Anthony Noto. He follows both of us because he's awesome, but he's somebody that's really, really cool, and I think he's a great leader.
Yeah, and just vaguely, I do have up their tweaked, obviously leaked earnings per se. Everything is up. Their revenue is up, but it's 322 million. That, hands down, it's the only thing that could be conceived as a negative, because even though, it's 322 million, up 49 from 1 year prior, it's below the 340 estimate, I believe. So, actually, no, my apologies, 286 million. Somehow I was under the impression it was 340, but still. So if that's good, then the 408,000 for new members, which is 70% up. 689. Yeah. Oh, except I think they have one extra zero, unless it's 4 million. That would be amazing. But I think no matter what they do, EBITDA is also up 49% year over year. There's so many good things coming from this, and I found it kind of comical, the fact that we're actually down 12%. And just so you guys have it as well, I do have the bid and ask as well, so you can see the live ticker. So when something is said during the earnings that you can clearly tell if the market likes it or not, you'll see it go up or down. So, but still, man, the fact that we're down 12%, 18%, at some time, at moments today, ooh, I don't know. Did you buy today?
I did not buy today. I bought my stuff yesterday. A lot of companies, but man, do I wish I would have not bought yesterday. I mean, no matter when you buy, it just seems to go down. And I'm not somebody that shorts companies. I hate shorting innovation and disruption. But right now, everything that you buy, it kind of just seems like it's going to go down. With SoFi, you've already beat earnings twice in the last two earnings. and we've only gone down. We got Bank Charter at $17. I was buying this company at 17, 18. I was feeling comfortable with it. And I'm still okay with that because I really do believe that this is a $50 company if they would have went traditional IPO. But they are disrupting the banking industry, and banks do not want them to succeed. It's really sad that we're seeing that banks are trying to destroy innovation and disruption. SoFi is going to destroy these banking companies, so I understand why they're doing it. Just don't get discouraged from the fact we are going to be well above $5.25. This is just enormous, enormous dip, and it's now a value company, and this was not a value company. So no matter what happens today, I honestly am just really excited to be a SoFi investor, being able to buy this. This is going to be a company that you're going to tell your friends and family that you bought in at $5.25 because they're not even going to believe you.
Yeah, and
I really want to buy. I mean, no, you go.
No, I think I've always said in a lot of videos, like a lot of retail investors like to look at institutions, and just the fact that these are the 13 Fs coming from SoFi, and I'm just going to sign in here actually.
Well, while you're saying that, a penny stock means that it's somewhere between a penny or 25 or $5. So you are literally buying SoFi almost at a penny stock value. I mean, I can't tell people enough how low this company is right now compared to what it's going to be. I mean, does this company not have 10x potential? I certainly believe it does.
Finally logged in, so you can see a lot of the averages that these institutions have. For the most part, a lot are still fairly small fish that are disclosing their positions, but still like 11, 15, 18, 16, 17. Like a lot of these institutions found huge value at these prices, as I'm sure a lot of you do. So it's mind-boggling. Like, just think, and I think a lot of the big players as well, because BlackRock is a big investor in SoFi, so it'll be interesting to see what they do. I believe they are coming out this Friday, and even more so, a lot of people seem to be talking about a short squeeze, and it does look like we have about 4 minutes left. Just want to make sure that we don't miss the start of it, but. So as far as some short info, can you believe we're actually over like 20% short interest going into earnings? Like, I don't know.
I mean, I honestly believe that the shorts won today. I do believe that they won today. But with that said, I do not believe that a short squeeze is out of the realm of possibilities. Do I believe that there's going to be a short squeeze? I actually believe that this is the time where SoFi has the most potential for a short squeeze that it ever has. So I really hope that we crush those shorts, because honestly, they have won for far too long.
Yeah,
but this is not one of those companies
shares. Like, it's crazy. Like, shorts are just like, and luckily enough, we're going into earnings, and I have always pointed at this fact out whenever I see it. Can you see this, guys? If it's too small, let me know. But cost to borrow minimum negative 0.3. So that basically means brokers are physically paying someone out there to short SoFi. Like, that's negative. Like, I found that absolutely hilarious.
That's honestly terrible. There should be more regulations towards that.
Let us know your thoughts overall leading into the earnings, if it's going to be generally positive, negative. Yeah, Ravi, exactly. Short squeeze is all it needs, and there's some good things that hopefully will come from this earnings as well. I hope they talk about how it was leaked at least, but still, I don't know. To be honest, I didn't actually see. Do you know roughly how much they have on cash on hand now?
I actually don't know. But what I do know is that every time that they have money, they're trying to get these huge partnerships, which is really, really agree. I mean, you saw Technisys and Galileo, so now they're a threat for the tech stack, as well as your AWS FinTech. I honestly think that they're just continuing to rise. Once we start to pick it, it's not going to. A lot of that I learned from King of Conviction and Focus Notice and JJ Trades, but SoFi is one of those companies that you need to just hold, and no matter what anyone says, because there is going to be a lot of articles that come out, those are just people that need to hit their quota. I'm a writer for Torque News, and I understand now that you need to write a minimum of articles, and that is something that was very eye-opening to me. Take every article that you see with a grain of salt. Do your own due diligence, because SoFi is going to be one of those companies that people are going to try to get you out of. That's just my that is my advice to you. Earnings are out already. Yep. We're checking on those.
Yep, they are. And I just have this vaguely up just to compare. This isn't updated yet, but last earnings, they had 505.71 million in cash equivalents. Long-term investments, which for accounting purposes, they count as still an asset as cash, 589.33 million, and debt 4.19 billion. So it'll be interesting to see the breakdown of what they have, and especially with the huge amount of member growth. It'll be interesting to see how that affected the bottom line.
We got JJ Tradester in here. Go check him out on Twitter. I love looking at his stuff. He's awesome.
Okay, guys. Looks like we got it. Okay, I'm going to mute my mic.
The results.
Thank you, operator, and thank you all for joining us today for SoFi's first quarter 2022 earnings call. Joining me today are Anthony Noto, SoFi's CEO, and Chris Lapointe, SoFi's CFO. They will share prepared remarks regarding the quarter's results and then take your questions at the end. Our discussion is complementary to the press release we issued today announcing SoFi's first quarter results. You can find it on the investor relations page of our website, investors.sofi.com. This conference call is being webcast live and will be available as a replay for 30 days, beginning about 1 hour after the call ends. There's also an accompanying investor presentation on our IR page. During the course of this conference call, we may make forward-looking statements based on current expectations, forecasts, and we discuss these factors in our SEC filings, including our first quarter 2022 Form 10-Q, which can soon be found on the IR page of our website and on the SEC filings website, sec.gov/EDGAR. As a reminder, we are not required to update our forward-looking statements. In our presentation today, unless otherwise noted, we will be discussing adjusted financial measures, which are non-GAAP measures that we believe are meaningful when evaluating the company's performance. For detailed disclosures on these measures and the GAAP reconciliation, you should refer to the financial data contained within our press release, which is also posted to the IR page of our website. Today's discussion will focus on first quarter 2022 results. As always, we encourage you to evaluate SoFi's performance on an annual basis, as quarterly results can be affected by unexpected events that are outside our control. Now I'll turn the call over to Anthony.
Thank you, Andrea, and good afternoon, everyone. I'm incredibly proud of our first quarter performance, given the resilience we demonstrated to deliver the strong results we're reporting today and our positive trends thus far in the second quarter. A few of the key achievements in the quarter include another quarter of record adjusted net revenue with 49% year-over-year growth, our seventh consecutive quarter of positive EBITDA, continued strong growth in members, products, and cross-buy volume, the successful launch of SoFi Bank, and our new SoFi checking and savings account offering, both of which are already contributing to our results. In announcing and closing the acquisition of Technisys to accelerate our innovation while also serving as a critical platform that accelerates our progress in building the AWS of FinTech. The strength of our results achieved despite volatile markets and the changing political, fiscal, and economic landscape also demonstrate how our strategy of building a full suite of differentiated products and services has actually created a uniquely diversified business that can not only endure, but outperform across market cycles. Because of the depth and breadth of our offering, we're able to make swift and critical adjustments in priorities and spend as conditions evolve in order to capitalize on growth opportunities and exceed our performance targets. I'm proud of how our team has successfully navigated each new challenge and opportunity, and in doing so, not only positioned SoFi for long-term sustainable success, but to be the company best positioned to be the winner that takes most in consumer fintech. Now I'll run through the highlights of the financial results for the quarter. We achieved record total adjusted net revenue of $322 million, up 49% year over year, and 15% higher than the prior record set in Q4 2021. Strong growth in all three business segments drove these record results. Lending adjusted net revenue of $244 million increased 45% year over year and 17% sequentially, despite the sixth extension of the moratorium on federal student loan payments, which has kept our student loan origination volumes at less than half of pre-pandemic levels. Financial services adjusted net revenue of nearly $24 million increased 264% year over year, with the largest contributions coming from record SoFi Money revenues and continued strength in SoFi Credit Card, SoFi Invest, and Lending as a Service. Technology platform adjusted net revenue of nearly $61 million increased 32%, with record Galileo revenues and a small contribution from our new Technisys multi-core technology business. Adjusted EBITDA of nearly $9 million increased 110% year over year and 89% sequentially. We are also very pleased with the member and product growth we achieved in the first quarter. We added 408,000 new members in Q1 '22, our third highest quarter of new member adds, ending with nearly 3.9 million total members, up 70% year over year. Notably, maintaining this growth momentum while opening a new bank was no small feat for our team. At a moment's notice, we had to navigate the operating and technological complexity of transitioning SoFi Money CMA accounts to the new SoFi checking and savings offering, which also required changes to our affiliate partners, as well as our marketing and advertising campaigns, creative and collateral. We added 689,000 new products in Q1 '22, our second highest quarter of new product adds, ending with nearly 5.9 million total products, an 84% annual increase. Financial services products of 4.7 million at quarter end grew 155% year over year, while lending products of more than 1.1 million were up 20%. The significant scale that we now have in our SoFi Money, SoFi Invest, SoFi Credit Card, and Relay member bases is driving even greater cross-buying. Our number of total cross-bought products in the quarter increased 22% year over year, demonstrating the continued success of our financial services productivity loop strategy. Our strong momentum in member, product, and cross-buy growth also reflects the success we have achieved in building the SoFi brand over the last year. We committed to investing more in product and brand marketing once we reached the appropriate scale and unit economics last year. That investment is already paying off well beyond our expectations, and we're just getting started. We took a giant step forward in achieving our goal of becoming a household brand name via our SoFi Stadium affiliation, the success of our integrated multimedia campaigns, and the virality of the influencers we partnered with. Our marketing team worked with 30 content creators across TikTok, Instagram, Twitter, and YouTube with a combined reach of more than 300 million throughout the NFL season and the postseason. Their efforts amplified the branding of SoFi and SoFi Stadium, and together drove more than 270 million impressions. Our unaided brand awareness, which had already increased more than 70% throughout 2021, more than doubled on Super Bowl weekend to an all-time high. We generated the highest SoFi-related search volume of all time on game day with nearly 230,000 and the most new visitors to our site since the meme stock craze in January of 21. And even without an ad, SoFi had nearly 5 times more online searches than the top-performing Super Bowl ad that aired. Now I'd like to discuss how our strategy to build the only vertically integrated one-stop shop for digital financial services has resulted in a uniquely diversified business model. In lending, we originated a record of more than $2 billion in personal loans in Q1 2022, up from $1.6 billion in the fourth quarter of 2021 and $1.3 billion in Q1 of 2021. Our results reflect years of investing to maintain an attractive credit profile and increasing our ability to capture more share of the trillion-dollar market. Our personal loan performance more than offset the continued lack of demand in student loan refinancing and the underperformance of home loans as we transition and onboard new fulfillment partners. We're also seeing the benefit of our ongoing investment to build and maintain a robust risk management framework in the current rising rate environment. We are constantly iterating, learning, and iterating some more while using data that goes well beyond traditional industry-specific underwriting data to drive the innovation in our credit underwriting models. We're also increasingly leveraging machine learning tools to improve the member experience throughout the funnel from application to income verification to approval. Because of these disciplines, our personal loan delinquencies and life loan losses remain at record lows, even as we hit new origination records, while demand to buy SoFi's personal loans has remained robust. The profile of our borrowers is very attractive to loan buyers. Our personal loan borrowers' weighted average income is $160,000 with a weighted average FICO score of 746, while our student loan borrowers' weighted average income is $170,000 with a weighted average FICO score of 775. Let me say those in numbers again, given how impressive they are. Our personal loan borrowers' weighted average income is $160,000 with a weighted average FICO score of 746, while our student loan borrowers' weighted average income is $170,000 and weighted average FICO score of 775. We are also differentiated in lending by the strength of our balance sheet and the diversification of our funding sources. Today, we have $5.5 billion of book equity on our balance sheet and about $7 billion in warehouse facilities we can access to fund loans. Not to mention the more than $1.5 billion currently in SoFi checking and savings deposits we've raised so far at SoFi Bank, which are growing by $100 million weekly. As we scale the bank, we are gaining even more flexibility in lending. We are already achieving savings by using our own deposits rather than warehouse facilities to fund loans. We've just started moving towards holding loans 6 months on average versus 3, which allows us to collect more net interest income. This also creates a more rational pricing environment for our paper as we leverage our ability to hold loans for longer should pricing not be acceptable. And we can now introduce new loan types and pricing models that improve our competitive positioning. In financial services, we've continued to achieve strong member and product growth by iterating on products to ensure they are differentiated by 4 key factors: fast, selection, content, and convenience, and continuing to invest to make them work better when they're used together. We finished the first quarter with 4.7 million total financial services products, a 111% annual increase, and more than 4 times our total lending products of 1.1 million. The more scale in financial services products creates even more scale in cross-buying and thus large marketing efficiencies. Just 1 year ago, that ratio was 2.4 to 1. And 2 years ago, lending products actually outnumbered financial services products by a factor of 1.6 to 1. Members have embraced the product launches in financial services introduced in the first quarter. We launched margin lending in SoFi Invest, which was one of the most common member requests. Another common request is extended hours trading, which we will launch in the coming weeks, and options, which we are targeting introducing by year-end. We introduced no-fee crypto transactions for SoFi Money members that do direct deposit, and we are assessing other possible crypto products to provide even more value to our members. Last but certainly not least, SoFi Checking and Savings provides an unmatched value proposition through an industry-leading APY of up to 1.25%, a host of free features, and a unique rewards program. The strategy is paying off as we've seen strong growth in direct deposit accounts and spending, while deposits have accelerated further since we announced the APY increase of 25 basis points last month. Transitioning now to our technology platform, which remains a critical element of SoFi's strategy, allowing us to innovate at a rapid pace while providing diversified, high-return revenue streams and an efficient cost structure. Already a market leader among U.S.-based neobanks, Galileo continues to expand its client base to include B2B and enterprise clients as adoption of modern cloud-based digital payments and banking has opened up new verticals, client types, use cases, and opportunities. For example, we launched 2 new clients in the first quarter that offer innovative working capital models for B2B and small to medium-sized businesses. Technology platform-enabled clients accounts increased 58% year-over-year in the first quarter to 110 million through new client acquisition and growth from existing clients. The large installed customer bases of Galileo's clients also provide unique growth opportunities for existing capabilities like instant provisioning, dynamic fraud engine, and 2-day early paycheck, as well as financial and engagement products in our pipeline that can drive greater customer activity like instant funding and direct deposit switching. Our March acquisition of Technisys further differentiates our technology platform by allowing us to incorporate a next-generation multi-product core banking technology into our lending and financial services platforms, and it enhances our value proposition for Galileo clients. This type of vertical integration enables faster innovation and growth, as well as greater operating efficiencies. Technisys also brings a complementary footprint of established banks, digital banks, and fintechs in Latin America, adding to the robust growth opportunity of Galileo's existing presence in Mexico and Colombia. Galileo and Technisys are already going to market together to offer new products and services to Galileo clients looking to expand their lineup. Early reception among existing Galileo and Technisys clients in the U.S. and LATAM has been very positive. I'll finish here by saying that we have been in an all-out sprint over the last 4 years to build out our digital product suite to meet our members' needs for every major financial decision in their lives and all the days in between. The benefits of our strategy to build a uniquely diversified business combined with a national banking license not only positions SoFi to be the winner takes most in the secular transition of financial services to digital, but also provide greater durability through a market cycle. I'm excited about where we are today and where we can go from here. With that, let me turn it over to Chris for a review of the financials for the quarter.
Thanks, Anthony. Overall, we had a great quarter with strong growth trends across the entire business. We exceeded our financial guidance while achieving record revenue and our 7th consecutive quarter of positive EBITDA, despite operating in a rapidly evolving macro environment. I'm going to walk you through some key financial highlights for the quarter and then share some color on our financial outlook. Unless otherwise stated, I'll be referring to adjusted results for the first quarter of 2022.
If you use Crypto.com to buy and sell
2021. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and 10-Q filing. For the quarter, we delivered record adjusted net revenue of $322 million, up 49% year over year and up 15% sequentially from the prior quarter's record of $280 million and $37 million above the high end of our guidance of $280 to $285 million. We also delivered $9 million of adjusted EBITDA, which came in $4 million above the high end of our guidance of $0 to $5 million. Looking at some of the annual trends, we've generated $1.1 billion of adjusted net revenue over the last 12 months, a 49% increase from the same prior year period. In addition, our Q1 annualized run rate was nearly $1.3 billion of revenue. We also generated $35 million of positive EBITDA over the last 12 months. Now on to the segment level performance, where we saw strong growth in record revenue across all 3 segments. In lending, first quarter adjusted net revenue accelerated for the second quarter in a row and grew 45% year over year to $244 million versus 30% in Q4 21 and 21% in Q3 21. Growth in lending was driven by 82% year-over-year growth in net interest income and 29% growth in non-interest income. Growth in net interest income was driven by improvements in NIM, both yield and cost of capital, an increase in loan balances, which grew to $7 billion, predominantly as a result of holding loans for a longer period of time, a very early benefit of having a bank, as well as 30% growth in funded volume. The largest contributor of funded volume growth was our personal loans business, which grew 151%, or $1.2 billion year-over-year, to $2 billion in originations for the quarter, a new high for us, and up 23% sequentially. This origination number is more than double our quarterly pre-pandemic average of $933 million in 2019. We were able to achieve this growth while maintaining our stringent credit standards and disciplined focus on quality. Our personal loan delinquency rates and charge-off rates have improved year-over-year. In Q1, 90-day personal loan delinquencies as a percentage of loans on the balance sheet improved to 14 basis points in Q1 22, while our annualized personal loan charge-off rate was 1.0%. Both 90-day delinquency and annualized charge-off rates in our student loan refinancing business also remain extremely healthy at 5 basis points and 27 basis points respectively. The increase in non-interest income was driven by growth in originations, strong sales execution, and prudent hedging. The lending business delivered $133 million of contribution profit at a 54% margin, up from $88 million a year ago and a 52% margin. This improvement was driven by ops efficiencies and fixed cost leverage. Shifting to our tech platform, where we delivered net revenue of $61 million in the quarter, up 32% year-over-year, versus a tough comparison driven by stimulus benefits and a rapid evolution from cash to digital payments in the same prior year period. Galileo contributed record revenue, while Technisys contributed a small amount following the close of the transaction in March. Overall, revenue growth was driven by 58% year-over-year Galileo account growth to 110 million in total. We also signed 10 new clients, 2 of which are in the B2B space, further diversifying our partner base. Contribution profit of $18 million represented a 30% margin, which is in line with the 20 to 30% margin range we have guided to in the near term, given the opportunities for growth. As discussed previously, we remain committed to investing in the platform to ensure that our tech platform is well positioned to capitalize on the secular shift from physical to digital payments and rising overall demand for more fintech services. Moving on to financial services, where adjusted net revenue of $24 million increased 264% year-over-year, with new all-time high revenues for SoFi Money, which is now transitioning to SoFi Checking and Savings, and continued strong contributions from SoFi Credit Card, SoFi Invest, and Lending as a Service. Improved monetization and exponential growth in financial services products drove our performance. Annualized revenue per financial services product increased 73% year-over-year, and the number of products grew 2.2x year-over-year to 4.7 million in Q1 22. All products were up approximately 100% year-over-year, and SoFi Credit Card was up 500% year-over-year. We hit 1.6 million products in SoFi Money, 1.8 million in SoFi Invest, and 1.1 million in Relay. Contribution losses were $50 million for the quarter, which increased year-over-year, predominantly as a result of now having a credit card business and needing to build our CECL reserves, which is expected as we continue to grow and scale. As of the end of Q1, the reserves are in line with industry peers. Excluding these reserves, contribution losses were $36.5 million, or up $1 million year-over-year. The next thing I want to address is our balance sheet. Overall, we are very well capitalized with ample cash and excess liquidity. The recent opening of SoFi Bank only reinforces the strength of our balance sheet and provides us with more flexibility and the ability to further lower our cost of capital. In Q1, our balance sheet grew by approximately $3 billion, and that was driven by 3 factors. First, cash equivalents, and restricted cash increased by approximately $900 million, primarily as a result of an increase in pledge activity to capitalize the bank, as well as increases in deposits at SoFi Bank, which totaled $1.2 billion at the end of the quarter. Second, loan balances grew approximately $1.2 billion as a result of holding loans for a slightly longer period of time. And third, we had a $900 million increase in goodwill and intangibles related to our acquisition of Technisys. We exited the quarter with $2.8 billion drawn on our warehouse facilities, which is approximately 40% of our overall $7 billion of capacity. Our current book value is $5.5 billion, and our capital and leverage ratios are extremely strong, both at the bank and at the bank holding company level. All right, I'll finish up with guidance. Throughout the last 12 months, we have demonstrated the benefit of having a diversified set of revenue streams and a keen focus on continuing to underwrite high-quality credit. We expect those benefits to persist going forward, particularly in light of the existing macro backdrop. For Q2, we expect another strong quarter of growth with $330 to $340 million of adjusted net revenue, up 39 to 43% year over year, and expect $5 to $15 million of adjusted EBITDA. For the full year of 2022, we are raising guidance and now expect to deliver $1.505 to $1.510 billion in adjusted net revenue, exceeding our recently provided full-year guidance of $1.47 billion, and expect to deliver adjusted EBITDA of $100 to $105 million, above our recently provided guidance of $100 million. Overall, we couldn't be more proud of our Q1 results and continued progress. Having delivered nearly $1.3 billion of annualized revenue and our 7th consecutive quarter of positive EBITDA, we continue to make great progress against our long-term growth objectives in Q1 22 and remain very well capitalized to continue pursuing our ultimate goal of making SoFi a top financial institution. With that, let's begin the Q&A.
Thank you. If you'd like to ask a question, please press star followed by 1 on your telephone keypad. If for any reason you'd like to remove that question, please press star followed by 2. Again, to ask a question, press star 1. Only one question and one follow-up if you have any questions. If you have any additional questions, rejoin the queue. We will pause here briefly as questions are registered. Our first question comes from Dan Dolev with Mizuho. Please proceed.
Hey guys, hey Anthony, hey Chris, great quarter here.
Hey there.
Hey guys, I have sort of like maybe a longer term question, and I think I was actually surprised to see the stock trade down today so much, and I think a lot of it had to do because you reported after Upstart, and I think there's a lot of confusion out there in the market from the from the calls that we're getting from investors about the nuances and the differences between the quality of SoFi and some of your competitors. Can you maybe talk to what people are misunderstanding here and what they're missing when they're sort of putting you in that group? Thank you.
Thanks, Dan. I'll start and hand it over to Chris to talk about the demographics and the credit profile of our member. I would say the biggest difference between SoFi and all the other, call it FinTech 2.0 companies, moving Square and PayPal out of that equation, so the more recently public companies. The biggest difference is we're building a one-stop shop with a broad suite of digital financial products for our members. We're trying to build a lifetime relationship with them to be there for every one of the major financial decisions in their lives and all the days in between. And we're doing that through a vertical integrated model so that we have best-of-breed products from the consumer standpoint, but also best-of-breed unit economics, and that'll allow us to have a competitive advantage. And as we build that growth integration, we're building technologies that we're turning into businesses as we have with Galileo and Technisys. And that results from a financial standpoint with a highly diversified business. Within our lending segment, we have 4 different types of loans. We're not just in personal loans, we're also in student loan refinancing, we're in school loans, and we're in mortgages. Within the technology platform, there's 2 primary businesses there, but there's more to be added in Technisys and Galileo, and they're incredibly complementary. It's a very high margin business, accelerates our rate of innovation, giving us a low cost advantage and giving us a return on our own technology development and lifting the book, all boats for the industry. And in our third segment, the financial services segment, is highly diversified with SoFi Checking and Savings, SoFi Invest. Even within SoFi Invest, we're not just in crypto, we're not just in single stocks, we're also in ETFs, we're also in robo accounts. And then we have a credit card, which over time will build out that portfolio. We have one today. We also do insurance as a lead generation business. We have the lantern and relay businesses. So we're very diversified. And one of the biggest reasons why we've been able to navigate the challenges of the last 4 years, and there have been multiple challenges every year, whether it's economic or industry related or credit related, is because we have that diversification and can reallocate our resources to where the best growth opportunities are. And that's why we continue to deliver record revenue despite the negative impact on the student loan moratorium. The last big thing I'd mention, and Chris will give you the details, is we're going after a high-end customer, mass affluent, high net wealth individuals that have a great credit profile, high income, and they need the products and services that we've developed. And most of the big banks have walked away from that broad suite of products. They don't offer mortgages, they're not in brokerage, or they don't have personal financial management, or they don't have career advice. And so, that results in us having a pretty diversified business. We've been EBITDA profitable for the last 7 quarters, and we're on our way to being GAAP profitable, and we're generating positive cash flow from EBITDA less CapEx and building our book value. And we have substantial book value. But that's the sort of biggest way to describe how we're positioned. And I'll have Chris give you the details on our income and our credit profile.
Yeah, thanks, Dan. What I would say is, just echoing what Anthony said, our demographic and credit profile of our member base is extremely strong, and we see that playing into our results. The weighted average income of our student loan refinancing borrowers is $170,000 with an average FICO of 775. The average income of our personal loan borrowers is $160,000 with an average FICO of 746. And then our overall credit profile and risk metrics are trending really well, both on a year-over-year and sequential basis. In terms of 90-day delinquencies, our PL 90-day delinquencies are at 14 basis points, which is down year-over-year and sequentially. And our student loan refinancing delinquencies remain really healthy at just 5 basis points. And then from a charge-off perspective, those remain really healthy as well and are trending in the right direction, with our personal loans annualized charge-offs at 1.04% and student loan at 27 basis points.
And the last thing I'd add is we have the most unique funding strategy and distribution strategy that makes us a low-cost operator in lending. We built the business end-to-end. We own from metal to glass, but we've also built out diversified distribution of our loans. We can sell whole loans, which is a great diversified market for us. We can hold loans because we're a bank who use deposits to fund them at a low cost, and we can access the ABS market if and when we think it's appropriate. And so we have a great competitive advantage in low cost, but also an ability to get really strong premiums for the credit that Chris just described through the broad distribution we have from our capital markets.
Got it. Thank you. Super helpful. And can I ask one quick follow-up here? We're getting some questions today, post that on the EBITDA for the second half. We've done the work. We know it has to do with the longer duration in deposits. But maybe Chris, can you quickly bridge for investors, the bridge from where we are in the first and the second quarter to that 40 million-ish ramp in the second half? That'd be helpful. And thanks again.
Yeah, absolutely. So we aren't providing specific segment level or product level detail, but to at least help folks think about the bridge from where we are to the $100 and $105 million guide, I would think about it in 2 buckets. First, the bank is going to start contributing much more meaningfully in the back half of this year. We're really proud to say that all new applications for our lending products are going through the bank as of a few weeks ago. Deposit growth is going extremely well, and as a result, we're going to start benefiting from a lower cost of capital, and we're going to start seeing the benefits play out of being able to hold loans for a longer period of time at scale in the back half of the year. And then the second bucket is related to growth in some of our higher margin businesses, specifically our personal loans business and PL. So collectively, those are the main things that would bridge us from where we are today to the guide.
Got it. Thank you so much again. Great quarter.
Thank you, Dan.
Thank you for your question. Our next question comes from John Hecht with Jefferies. Please proceed.
Afternoon, guys. Echo those congratulations on good numbers in a choppy environment. So my first question is just, I know it's very early on, but maybe can you give us kind of your perspective on early progress within the bank and kind of what KPIs you're looking for and what we should look out for over time?
Yeah, thank you, John. One of the key strategies of having the bank license is being able to offer a super differentiated checking and savings account. When we originally launched SoFi Money, we were not a bank back in 2019, and we were sort of, beholden to the interest rate that we could get from sweep partners. But now, as a bank, we can offer the interest rate that we think is most attractive. And currently, we're offering up to 1.25% on checking if you do direct deposit with us. And you get a host of other benefits as a member and other benefits in that account. We charge no fees. We do free roundups. We have overdraft protection. You get a free certified financial planner, our relationship, in addition to all the other breaks you get on other loans, et cetera. We've seen tremendous uptake of that product since we launched it. I will say, and this is in my prepared remarks, it was incredibly challenging waiting for the Federal Reserve and the OCC to give us the final approval. It wasn't clear when they were going to do it or if they were going to do it, given the political environment we're in. And so we were sitting ready with marketing and collateral and plans and technology and operations ready to flip the switch. But once we did that, it took a while to get things rolling in Q1, and we came out of Q1 and Q2, really seeing the benefits. Our direct deposit uptake is up 60% on a conversion basis, and the number of direct deposit accounts added per week has doubled in Q2 versus Q1. And as Chris mentioned, we're up to over 1.5 billion of deposits, and it's growing at about $100 million of deposits per week. And the feedback from an NPS score basis is really strong. So we couldn't be happier with that competitive advantage that we now have. As we bring people in through the top of the funnel, it increases the amount of cross-buying we have. And as you know, in a personal loan product, we double our variable profit per loan when someone cross-buys from Money or Invest into that. And Money is really one of the products that things start with, as is Invest and Relay. And our customer acquisition costs there are very attractive, and we're actually leaning in even more because the LTV is proving out to be even higher than we thought based on early indications. So really happy with that product. The second thing I'd say is, it took a while to get the bank and go through the process. And there were plans that we had specifically, like the checking savings account and funding our new loans in the bank. But there are other opportunities that are now coming to light, such as having a sponsored BIN business that we can partner with Galileo on. They have B2B partners that they're adding. There's a lot of demand in the B2B channel. Well, we can be a sponsor bank in B2B. And so that's a new revenue stream that we're working on with the regulators to launch and with our partners there. So there's a number of other things that will come down the pipeline as a result of having the bank that weren't contemplated until we actually got the license.
That's very helpful. Appreciate all that detail. A follow-up question. Maybe just because it's been a volatile market, I think credit spreads are drifting around, and obviously interest rates are moving upward. Maybe talk about the components of the gain on sale, and is there any kind of different trends you're observing on your different asset types, and kind of the outlook for that?
Yeah, I can take that one, John. So what I would say is that there are a few important things to note when thinking about the overall trends in gain on sale margins, especially on a quarter-to-quarter basis. And there are a number of factors that play into that, most predominantly rates, spreads, and then obviously the price that we're charging on the loans that we sell. In addition to those factors, it's really important to incorporate the impact of hedge gains and losses, which are critical, particularly in an environment that we're in right now. So in Q1, our gain on sale margins, excluding hedge gains, were 4.2%, and they were north of 4.5% once you include hedges associated with loans sold in period. Our student loan refinancing business had gain on sale margins of 1.5%, excluding the hedge, and north of 4% once you include the hedges. And then our home loans business was negative 60 basis points, excluding the hedge, and north of 2% once you include the hedges. So they've been relatively consistent on a hedge-adjusted basis over the course of the last
several quarters, and we expect them to be able to maintain that. The only other thing I would say as it relates to our lending business is that we obviously seek to maximize profit dollars in our lending business and stay within a 40 to 50% contribution margin range. And we obviously have a number of levers to do that. Despite the rapidly rising rate environment that we've been going through over the course of the last quarter plus, we were still able to deliver $133 million of contribution dollars at a 54% margin across our entire portfolio, even as rates went up 80 to 150 basis points across the curve.
And one of the other things I would just add, John, for the benefit of those that maybe weren't that close to the company back in 18 and 19. When we joined in 2018, Michelle and I were looking at 4 to 5 rate increases throughout 18 and 19. And we rapidly developed a strategy of being able to test 6 different 6x6 grids simultaneously in the marketplace. And at that time, the company really only had the ability to test 2 prices. We spent the better part of 2018 not just testing all these different prices and building that capability, but also understanding the unit economics by marketing channel and perfecting that over time. So the level of sophistication we have in marketing, pricing, and credit is really built over the last 4 years. So as rates are going up, even though our funding costs are going down, we are being prudent about making sure we have the right price for the right credit through constantly testing and also leveraging different channels that we know have certain types of loan losses and quality performance. In addition to that, we have an early warning framework that our risk team has built out that we actually executed at the beginning of 2020, the beginning of the pandemic, to make sure that we're in a position to be able to pull back if the economic conditions start to provide leading indicators that are at risk. So we're playing on both ends of the spectrum, offensively with pricing and channels, and then if the market turns over in some way that's not what was predicted, we can also pivot back the other way.
Wonderful, guys. Thanks very much.
You're welcome.
Thank you for your question. Our next question comes from Dominic Gabriel with Oppenheimer. Please proceed.
Hey, thanks so much for taking my questions and great results. If you just think about your investment initiatives, how may have those changed since the end of the year 21 versus today, since the market seems to be signaling, a changing consumer environment? Have you changed any of your kind of investment dollar targets for your various business mix? And then I just have a follow-up. Thanks so much.
The answer is yes, and it's been like that every quarter since we launched the business. We do an annual planning process that starts in the fall. Our staff sets the priorities for the company for the following year. We did that in September and October. We laid out 6 priorities. The team then does the bottoms-up financial plans against those 6 priorities, and then we start the year. Around mid-February, we start what's called a March revised forecast, which will be a revision of the plan based on everything we've learned. And so all the market conditions that change from December, January, February, and the performance of our business get factored into that revised forecast. We go through that same process every quarter. That's what allows us to assess where are things going well, where are things more challenging than we thought, how do we reallocate our resources against that umbrella of 6 priorities to deliver the results. So, and we do a weekly, latest call process as well, evaluating all the nitty-gritty details across all our funnels and our products and our financial performance, so that when we go into that revised forecast, we're not starting from scratch. We've built it on the back of 7 or 8 weeks of actual results in the quarter and what we're seeing in forward curves and the competitive environment, et cetera. So it's a constant process, and when you have the diverse set of businesses that we have, it gives you a lot of advantages, and you're not stuck in one silo. I'm not going to give you the specifics because it's multifaceted, but obviously the personal loan business did much better. We saw that opportunity and we leaned into it. Student loan business got negatively impacted by the president's unexpected extension moratorium. We pulled back significantly the marketing there and reallocated it. In fact, we're starting to reallocate more aggressively to things like checking and savings because we're seeing the flow through to the loans and higher LTV justifying more investment there. So it's a constant data-driven process.
Great. And then just for my follow-up, if we just think about the moratorium versus the floating idea of perhaps even $10,000 of debt relief within student lending, how does that impact the business versus the moratorium? And I really do appreciate the early remarks on the high-income customers. I would assume those folks maybe took out larger loans on average than just the average loan person within student there. So any color you could provide on how that might affect your business and how you're thinking about that dynamic between the moratorium and the $10,000 per person debt forgiveness. Thanks so much.
Yeah, no, absolutely. And I'll try to take a broader perspective on this to educate those that may not be aware. So prior to the pandemic, our student loan refinancing business had an average loan size of about $70,000. So the average loan that was being refinanced was $70,000. And we are doing over $2 billion of quarterly refinancings. Since then, we've operated at 50% or below, other than the fourth quarter when people thought that moratorium was going to end in January, and we saw a big surge in late November and December. So about $70,000, the demographics Chris mentioned have generally been the same. What people should understand is anyone that's already refinanced with us would not be eligible for a federal student loan forgiveness because they now have private loans. The federal student loan forgiveness that's been talked about has ranged from $10,000 for everybody, to $10,000 for those that were in economic need below a certain income class, to $50,000 for everybody. What the President Biden campaigned behind was $10,000 of forgiveness for those that had a need. He didn't quantify it. What's been talked about more recently, the President has said, I'm not interested in $50,000 of forgiveness per person, and his advisors have pointed more towards $10,000 of forgiveness below a certain economic level. There's a lot of debates on economic level. I've heard everything from $75,000 of income to $125,000 of income. The best thing for SoFi and for SoFi shareholders in our business is if he announces, the best thing is he ends the moratorium and we just move on. But that's unlikely. What's more likely is some level of forgiveness. If there is some level of forgiveness, $10,000 and below, I think would be great for our business. Now you may say, even if that applies to everybody, even if it applies to everybody, there's a cohort of people that have been waiting and waiting and waiting for student loan forgiveness, and they have not refinanced. And that's in our demographic as well. Once there actually is forgiveness, there's nothing to wait for anymore. You now know what the plan is, and you have to make a decision. Well, if you had 70,000 loans, which is our target market, and you get $10,000 of forgiveness, you still have to refinance $60,000, but the number of people that will be refinancing will be magnitudes greater than it was in the past because there's really no reason to wait any longer, especially with rates going up, and there's likely not going to be a second wave of forgiveness. The scenario where there's $10,000 of forgiveness for people with $125,000 income or lower is really advantageous to us, given the demographics that we set at a weighted average income of $170,000. And so that's the way I would think about it. In terms of our financial guidance, we've assumed that the moratorium will extend all the way through 2022. So our guidance that Chris mentioned of $1.505 billion to $1.510 billion is an assumption that the student loan business does not recover. In fact, it continues to be relatively depressed and it could wane even more.
Excellent. Thanks so much for all that color.
Thank you for your question. Our next question comes from Mike Ng with Goldman Sachs. Please proceed.
Hey, good afternoon. I just wanted to ask about the origination outlook for home loans specifically. I know you called out some fulfillment partner issues. Can you just talk a little bit about whether you see that easing in the back half and could home loan originations accelerate? And then, could you also just talk about the backdrop of competition and the softening refinance environment? How does that affect how you think about home loan originations for this year and next? Thank you.
Yeah, we do have an opportunity to significantly improve the value proposition to our members in home loans and our execution on the operational side. The execution and operational side is what's holding us back. We have moved from an existing partner to one entirely new partner. In doing that move, things haven't proceeded as fast as we'd have liked, which is a great highlight for how the diversification of our business allows us to overcome something that's underperformed. And so two things have happened in the home loan business. One, we've moved to that new partner, and there's growing pains and execution pains there. At the same time, the team has had the additional challenge of the mix of home loans moving from refinancing more towards purchase. Purchase is a different operational process, as you can imagine, and it's really critical in those scenarios that you hit closing dates, et cetera. And so we're erring on the side of trying to provide the best level of service we can. And so we really haven't stepped on the gas pedal as it relates to driving top of the funnel demand, because we want to make sure we can get the backlog of loans that we have in the system, especially in purchase, through the system successfully. There are definitely challenges there, and we underperformed in the quarter. I'm confident the team has the right plan and will work its way out throughout the course of the year. It's a product our members love. Still 60% of the home loans we do are from or more from our existing members. It's one of the most important financial decisions they'll make. It's one of the probably biggest emotional decisions that they'll make, and we need to be there for them and give them a great product and a great service. And it's still a huge opportunity for us given how few loans we've done for our members and the magnitude of the user base that we now have. Not to mention stealing share from as a first product.
Great. Thank you very much for the thoughts, Anthony.
Good. Thank you.
Thank you for your question. Our next question comes from 𝗪𝗓𝗡𝗘𝗧 from Bank of America.
Hi, thank you for taking my questions. Maybe just to start, can you just talk about your macro expectations for the rest of the year?
Yeah, absolutely. So in terms of the overall macro expectations, we are assuming that rates will continue to increase. What we've baked into our forward guidance is that we would have 7 additional rate hikes between now and the end of the year.
Got it. And then anything, and then the rest of it, any other color you can provide beyond just the rate hikes? Like just what are you assuming for, I guess, unemployment, consumer health, those kinds of things? Anything at all you can provide there?
Yeah, we're assuming that the inflationary environment stays similar to where it is today. We are not assuming a recession. We do have early warning, frameworks that will allow us to get in front of some type of deterioration in the economy that's of the magnitude that would have an impact of life and loan losses. We've been doing this for 4 years and lived through this cycle before, and so we'll be vigilant on that front. But right now, those indicators are showing relatively strong demand and a relatively stable economic environment. And as Chris mentioned, the performance of our credit has been quite positive.
Great. No, thank you. That's helpful, and that's quite consistent with what we've heard from others too. So I think that's good. I think one other question I just had to follow up in terms of, I think John asked about KPIs within the bank earlier, and I apologize if I missed this. But did you give the direct deposit penetration rate maybe with your members and just the amount of cross-sell you're seeing between bank deposit holders and your other loans? Thank you.
We have not given the specific numbers and specific KPIs. That's something we'll evaluate over time. The only thing I said was that the weekly ads have doubled since we came into Q2 versus Q1, and on prior calls we had seen a good ramp increase based on our strategic focus in the area by adding critical elements of value to the equation. But the checking and savings conversion and the high interest rate of 1.25% have really taken it to the next level. As I mentioned, it's up 2.7 times in Q2 versus Q1. And we've seen an increasing conversion of accounts funded to direct deposit of 60% in conversion.
Understood. Thank you. No, and good execution again for the quarter. Thank you.
Thank you.
Thank you for your question. Our next question comes from Tim Chiodo with Credit Suisse. Please proceed.
Great. Thanks a lot for taking the question. I wanted to dig into the financial services segment for the non-interest income. So strong growth year over year, absolutely. But when we looked at it on a quarter over quarter basis, maybe there's just some seasonality there. Maybe you could just help us in the modeling of how we should think about the non-interest income for that segment into Q2, Q3, and really for the rest of the year.
Yeah, I can take that one, Tim. So what I would say is we saw really good momentum year over year, as you alluded to. Quarter over quarter, we saw a sequential growth in products of about 15%. Money and credit card combined delivered $10 million of revenue in the quarter. That was up $2 million or 22% sequentially. That was primarily driven by interchange as well as some NIM. Our Lantern and Pagaya businesses combined, or lending as a service, delivered $8 million on the quarter. That was up $2 million sequentially, or 30%. And then our Invest business delivered $5 million of revenue. What I would say in terms of the forward outlook, again, we don't provide it at the product level, but we do expect to see continued strong momentum and growth in product count across all of the products, as well as improvement in monetization. If you look at our annualized revenue per product in the financial services business, that was up 73% year over year. So we've made really good improvements over the last several quarters in continuing to monetize those products and members, and we expect that to continue going forward. And the way that that's going to increase is through continuing to drive AUM, continuing to drive spend. We're seeing really good trends in that right now, especially opening the bank, and then obviously launching new products and features like options that we expect to do by the end of this year.
And there's one thing to remember, and I think people know this, but just in case, we'll have the bank for a full quarter in Q2, which will benefit that segment, versus only 1 month in Q1. Yep.
Excellent. Great. Thanks a lot, Chris. Really appreciate that. The other one was just a quick follow-up. Just so you made a comment that kind of caught my attention in the prepared remarks around strong new accounts at Galileo for sure, but then also you mentioned in terms of new customers, a couple that were in the B2B area. If you could just put some additional context around that, that would be greatly appreciated.
So our product at Galileo, the platform, lends itself not just to consumer-driven businesses, but Galileo has been a leader in the B2C space and neobanks since its inception. Since we bought it, we've seen an increasingly amount of demand in enterprise space. The number 2 partner within Galileo, which has been number 2 for years, is actually an enterprise customer, not a consumer customer. So it has that flexibility, and so we've signed a number of enterprise partners, some of which that it's for accounts payable, accounts receivable payments, and working capital, in addition to other types of businesses that are in the gig economy. So we're not naming specific names. We'll announce those in conjunction with our partners as opposed to during our earnings call. But that's increasingly a big channel for us, and we have a pipeline to better serve the enterprise and SMB space holistically based on the demand we're seeing.
Excellent. Thank you, Anthony. Appreciate you guys both taking those questions.
Our next question comes from Jeff Adelson with Morgan Stanley. Please proceed.
Hi, good evening, Anthony and Chris. Just wanted to understand the trajectory of personal loan growth here in your assumptions. A really nice quarter for that line. What kind of growth maybe are you assuming in your guidance for the rest of the year? And then just as you kind of look under the hood there, are you seeing more demand from your customers for that product? Or, I mean, if I understood Anthony's comments correctly earlier, it sounds like you're, putting more marketing dollars at that area. And, could you also kind of help us understand how your ability to pass through interest rates is going there? It looks like from the Q, you were able to increase the rate there about 40 bips Q on Q, and you've got the 2-year rate going up 160 bips roughly. So just want to understand all those little drivers there.
Yeah, on the personal loan side, I'll let Chris talk about the outlook. In terms of driving demand, I note a couple of macro things and then things that we're doing on the micro side. As interest rates go higher, we saw this in 18 and 19, we see people refinancing out of variable rate debt, like credit card debt, and other high rate variable debt into fixed rate term loan debt. And so our product is really conducive to doing that, and we capture that demand. Additionally, as rates go higher, if you go back and look at our advertising in 2018 and 19, you'll see we had a use case advertising behind home improvement. So as interest rates go higher and individuals look to remodel their homes instead of buying new homes, that product also benefits. One of the things that we can do now that we weren't that able to do in 2018 and 19 is we can market the product to our existing customers. And when we were going public, we provided a presentation that showed you the percent of our loans that were cross-bought, and it's averaged in the 20 to 30% range. And so as the business has grown, it's stayed in that range, and that's a really efficient way for us to market to our customers. And so we'll be leveraging that through this environment as well. In terms of the trajectory of it in the outer quarters, I'll have Chris talk to that.
Yeah, so in terms of the trajectory, we are providing forward guidance on originations, but as you know, we saw really good growth at 151% year over year, and we ended up exiting the quarter with about 5.5% market share when you look at the overall TAM of our credit box, and that's in comparison to about 4% in Q1 of 2021. So we do expect to be able to continue gaining share over the course of 2022, and if rates continue to increase, we do expect the market to continue to expand.
And the other thing I just mentioned on the marketing side, we can afford to be a little bit more aggressive on the marketing front and open the aperture a little bit because of our decline monetization strategy. This is a product where we're approving 30% of the applicants. Previously, the other 70% were sort of lost, and so we launched Lantern, and now we're letting as a service that we have in our own application process. And so we can be a little bit more aggressive on marketing and drive a return against that because our declines can be monetized in those two ways.
Yeah, and then the one last thing to address your final question about passing rate increases through WAC, especially in the PL business, we've made really good progress on thoughtfully increasing pricing, and demand has remained extremely robust, as you saw in the quarter. Overall, on the balance sheet and through our originations in the quarter, we were successfully able to raise WAC both in PL and SLR. So making really good progress there, and it's showing up in the results.
And then if I could just kind of follow up on the student loan side, assuming that the student loan moratorium does go away at year end or even before then, is a reasonable way of thinking about your guidance here going forward maybe that the original 2022 number for EBITDA of around $250 million is potentially a right way to think about 2023?
Yeah, we're not providing specific guidance around 2023 at this point. We've shared, the quarterly impact on the SLR business and the result of and the impact from the extension, but at this point, we're not prepared to talk about 2023.
But the one thing I will say is, as the student loan business comes back, or if it doesn't, as we exit 2022, we will go back to a 30% incremental EBITDA margin philosophy. And the reason why I'm emphasizing that is there's a lot of different ways to think about shareholder value creation. We believe return on invested capital is the most highly correlated metric with shareholder value creation. I think it's better than ROE. We'll look at both. For us to get to the return on invested capital that we think we can achieve with our mix of businesses, that's in the 30 plus range. We have to have a 30% EBITDA margin and low capital utilization as we have today on the CapEx side of the equation, which generates great flow through from EBITDA to free cash flow, which will then build our book value. And so as we exit 22 with or without student loans, we'll be back to a 30% incremental EBITDA margin. If we have the benefit of the student loan business, that will just be more incremental revenue and more incremental EBITDA at a 30% rate.
Got it. Thank you.
That is the end of our Q&A session. Now I'll turn the call over to SoFi CEO, Anthony Noto, for closing remarks.
Thank you all, and thank you to everyone for joining us this afternoon or evening, wherever you are. Before we wrap, I wanted to share some final thoughts. At SoFi, We are no stranger to adversity. As we near the halfway point of 2022, there is no shortage of challenges ahead, but there has been no shortage of challenges every year since we joined back in February of 2018. And with each set of unique challenges, we have risen to the occasion each time. I cannot predict the future, but I can assure you that we have the best strategy and the most diversified set of businesses that have delivered superior, consistent financial performance, yet generating both high growth in revenue and strong profits as measured by EBITDA. We also have significant financial resources with more than $5 billion in capital and a battle-tested team. Most importantly, I can assure you that we will work tirelessly to be prepared as best we can wherever we face ahead, just as we have over the last 4 years. I love our team, I love our strategy, I love our company, and I love where I work. I wake up every day trying to be a better leader than the day before and reminding myself that those who dare win. Until we talk next time, thank you for your interest in SoFi, and thank you for your support.
Goodbye.
Okay, so that, in my opinion, just first impressions, well, that was impressive. Like, if you're going to compare that to other, like, earnings calls, like, I'm impressed. And clearly after hours, it shows a little bit more optimism, especially I think the broader market is starting to have a little bit more optimism. But bullish mindset, what's your thoughts? Oh, can't hear you.
Sorry, I was still muted. No, I'm honestly really impressed. I really love SoFi, and I honestly think that every single time Anthony Noto opens his mouth, the market needs to react very, very well. He's a great, great leader, honestly. Honestly, Peter Rollinson needs to take a book out of his, or page out of his book, because he is phenomenal. He was not scared of any of those questions. He understands that this is going to be an uphill battle with trying to fight the institutions that are trying to push this company down, because they are trying to disrupt the banking industry. I honestly believe that SoFi is going to do it. It's going to surprise a lot of people, and this is the type of company that I want to be with. This is enormous amount of upside with this company, and I honestly do believe that Anthony Noto is going to make every single right decision. He was the CFO of NFL. He was the COO of Twitter. Someone said that he worked for Goldman Sachs. This guy is absolutely unbelievable. I'm so happy about this earnings call.
Yeah, and I'm just showing you guys this because, again, when I'm comparing, I've had a lot of earnings calls. None have been nearly as good as this. And I think there's some kind of things read between the lines kind of situations. So these are all the recent upgrades, downgrades, and all the pricing. I'm sure a lot of us know this. Bank of America obviously wasn't a fan of us. Same with Morgan Stanley. The mere fact that they both spoke, Bank of America seemed very impressed by it. Morgan Stanley seemed a little bit more whatever. But still, I think the fact that we had so many questions that we are going to see a lot of activity tomorrow. Just mark my words, we're going to see a lot of analysts give a lot of good ratings because, even just Mizuho, if I'm saying that right, them giving reiterating a $14 price target, just by not even hearing the conference call, just by seeing the basic numbers, man, that, this is good. I feel good. And I'm sure majority of you guys already know, both Bullish Mindset and I myself, we both cover Lucid quite a lot. I did not get this hyped up. I'm a big Lucid fan, clearly, but I wasn't as hyped from their earnings call. This one, wow, I'm very impressed.
This was one of the better earnings calls that we've actually done on this channel, and I'm honestly so psyched because they were, getting destroyed by the market today, and they even got halted. Everybody even knows that. That's probably why there was a ton of people that were interested in this company, but they destroyed on every single cylinder. Honestly, I absolutely love this. What you see with SoFi is I was even seeing it in the chat. The market capitalization is lower than book value. They have so much upside for this company, and they're disrupting an industry that has not even been disrupted before. They are AWS of fintech. I honestly just believe that if you hold this company, this is going to be going to $100. This is going to be easily going to $100. I don't even want to specify, but Anthony Noto is going to be that next leader that I don't care what he does after this, I'm going to follow him. I love this. I'm honestly very excited, and I don't see the pain hitting us very, very long. We can't be a penny stock. I mean, going under $5 would be absolutely nuts for me.
Yeah, and there's a couple of things as well behind that backing, but just before I touch on that, like looking even just at the revenue, like even every single past quarter, like I don't think people realize this, but we've beaten on every single revenue. So you can see the surprise up 25 mil, 25 mil, 18 mil, and I believe this one is 40 mil, something like that, as far as the surprise. So revenue, we've been doing phenomenal. Funny thing is I lost my train of thought. I should have actually spoken that first, but still, I completely agree.
I agree with Simba too that so many people are going to want to be getting in tomorrow. I think that they understand that this company is trading at a seriously low valuation, and now it's not even just a growth company. It's not a company that you need to really bet on as it's going to grow into their evaluation. It is lower than the book value. So you were buying a company that is going to innovate an industry that is uninnovatable or undisruptable. I'm sorry. So they're doing that, and now you're going to have the upside of it being so undervalued. Anthony Noto, I believe, has so much experience with very big industries. Like the NFL, he was the COO of Twitter, and you saw a lot of upside within those industries as well. I think that he's going to take what he learned with SoFi. This is going to be what he's remembered for. There's going to be Zelle integration, cryptocurrency integration on the platform. You're seeing that there was users of 408,000 members being downloading the app. You heard him about the content creators like Mr. Beast, 300 million subscribers that they all had together. That is enormous amount of people, and it just makes SoFi a household name. SoFi has done everything that I've wanted them to do, in my honest opinion. Even exceeded my expectations.
Yeah, and even from an investing kind of basis to compete against Robinhood, like the fact that they said that within a couple of weeks they're going to have extended hours, and I might have this wrong. I think in my head at least they said at the end of the quarter they're doing options activity. I believe I could be wrong, but still, like options activity, extended hours. Like you guys are stepping up your tools, as what they said, to make better investors. And I liked how he started with that. He started by saying, before going over, he's like, we're giving the investors the tools necessary to succeed. I'm like, you don't hear many companies say that. I don't think I've ever heard Bank of America or any other company say that. They don't give two craps about anyone. I like it. Smelling cool. SoFi get big enough to buy PayPal. There we go. Oh, okay, Michael, by end of year. Okay, maybe I had that wrong. Okay, options by end of year.
But we did know that the options was going to be integrated into their app. We heard that Zelle was going to be integrated as well. We heard a lot of things that weren't even talked about on the call. But the thing about it is, SoFi is going to surprise investors. Like Lucid, they're going to they're going to under promise, over deliver. And I think that's something that a lot of people like about SoFi, because you weren't really expecting anything. And then we had a halt. I mean, they beat earnings. They got the bank charter. They've done everything that they've needed to do. 2 straight quarters, and all we've done is fall. So this isn't really on SoFi. This is just going to give people an opportunity to be buying into SoFi as institutions and value investors. With that said, though, SoFi is going to make a lot of people a lot of money that hold it, because there is going to be a lot of things that they're going to just not necessarily tell us, but it's just going to happen. Kind of like the Saudi Arabia deal with the Lucid for the 100,000 vehicles. It's going to be kind of similar to that. So I really do like that Anthony Noto has done that time and time again, and I honestly am excited to see how we progress over the next earnings call. And I do want to see what our price movement's going to be tomorrow, because we should not be anywhere near these levels. If we see a 18% day or something, I would not be surprised. So we just need $7. We need to hit $7 and then continue to build support. And I do believe that this is going to be the inflection point of SoFi.
Yeah, fair. That's very well said. Yeah, I don't know. Depending on CPI, how that plays out tomorrow, I think I'm for sure going to be. I think I might be capped out with Lucid, but SoFi, like well below the book value. Like you're getting to. I know a lot of other growth stocks are similar to getting to that stage, but like SoFi has exceeded that. I remember I was just vaguely looking, and I saw SoFi down 18%. I was like, well, what happened?
Yeah.
I was like, well, what the hell? I don't know. But yeah, impressive.
Yeah, no salary. No salary cap. He commented CNBC's poll voted SoFi best fintech company to invest in. So on CNBC's disruptor list, I think in 2018, SoFi was the top disruptive company for the last 3 years. So, and then with Kamath Palihapitiya taking them public with IPOE, you're having a lot of people that are actually involved in this company that are kind of geniuses in the terms of they understand how to really create an amazing company and create a brand. Because you're seeing that with SoFi Stadium. I mean, that's a beautiful stadium that if you guys have not checked out, please go look at that up. And Mark Rober, Mr. Beast, I mean, Logan Paul, they've all done things in this stadium that have just kind of increased the potential of the brand recognition for SoFi. So I honestly think that they're doing things that nobody else is doing. I mean, they had the Super Bowl there. So you could have a Super Bowl commercial, but nobody had more exposure than SoFi.
Yeah, didn't even say his SoFi searches were 5 times that of the best Super Bowl ad.
It was either 5 or 10 times, but
yeah, just like,
or
wow.
5 or 8 times. Yeah,
that's something I didn't know.
Well, one of the reasons that I kind of went all in, I've been following this company for a couple of years, even before they went public. But one of the reasons that I really went all in is because I understood that Anthony Noto had a great contract or great recognition with the NFL. They had a good partnership going on. He knew people in there, and just understanding that he's going to be having that recognition every single time for every Sunday that the Chargers or the Rams play, and those are LA teams. And then you have the Super Bowl, and then they won the Super Bowl. So SoFi is kind of playing this very differently than the other the banks that have been there forever. SoFi is taking a different approach, and I honestly think that is the reason that their brand has built up so much. Obviously, the stocks have been going down, but you saw Amazon go down $100 to $6 1 year. And look at where those share prices are. It's like $3,000 per share. It's the exact same thing that's going on with SoFi. If you hold at these levels, you're going to be bragging to your friends that you bought SoFi at $5, in my opinion. I'm going to be doing that. That's why I bought, I think yesterday, I bought on Monday some SoFi, and I'm going to be very, very, very excited. SoFi is the AWS of fintech. So if you think about SoFi mixed with Amazon, companies are going to need to go to SoFi. It's not like they're competing directly with the banks. No, the banks are going to have to go to SoFi, or they're going to have to, figure out some way to compete with SoFi. But I really don't see them competing with SoFi. You're going to need SoFi.
Yeah, and still, I think you can even tell on Twitter, there's some people that are still chatting and thinking that it's going to be a squeeze. Because looking at all of this,
certainly hope.
Yeah, 147 million shares being shorted. Like, that's a lot. Even if, arguably 20% of that, which most likely would be more than that, but arguably even 20% of that covering, that would give us a very good push. In combination with a lot of good analysts giving ratings tomorrow, which, again, mark my words, I think that's going to happen. But 21% roughly short interest is way too high on such this stats. This 21% is typically should be for a garbage company. That's not the case.
I mean, it's trading like it's a penny stock that has a 2% chance of actually succeeding. And as we know, it's kind of like a 98% chance that they succeed. SoFi's not going anywhere. They have the money. That's why the Galileo Technisys acquisitions were about, what was it, $2.5 billion. And SoFi's market capitalization is what, 5.5 billion. even probably lower than that. So honestly, the acquisitions were almost more than the entire valuation of SoFi. This is just laughable or comical what we are seeing with the valuation for SoFi. And honestly, if you're a long-term holder, even if you're not, like even if you have a 3-month time horizon, I honestly think that SoFi is going to make you money.
Oh yeah, like there's not too many stocks out there that you can think that is going to thrive in a higher interest rate environment that is a disruptor. Like you don't typically hear that in the same sentence. A growth stock that's going to thrive in a higher interest rate environment. Can't go wrong with that. Oh yeah, I think bullish mindset you were talking about, similar to what Mazda said. I guess the college national championships. I think you were saying that, right? At SoFi as well. I think you were saying that, weren't you? You said something else. Some other big event was there that's coming up. Whereas
I didn't actually know that, but what I was talking about was just a lot of the content creation that's going to be there. There was 300 million subscribers amongst all of those influencers. I mean, 94 million subscribers was with Mr. Beast, and he's only going to get bigger. So he's probably going to be one of the largest influencers in the world. And his dub channels, like his channels amongst all of his YouTube, it's about 200 million subscribers. So they didn't even add that in there. They probably got around 500 million subscribers or people watching based on just their content creators that were there. So honestly, and those were conservative and very low numbers, and they probably didn't know about all the other channels that he had. So honestly, I think that this was enormous news that content creators actually want to create content in SoFi, and they're already getting all of these amazing events that are going there because it's such a beautiful stadium. If you go to the stadium, just look up SoFi Stadium. It is the nicest stadium that I've ever seen. It is the nicest stadium that there is right now. And the fact that they have the name SoFi Stadium, it's incredible. That is just going to allow the brand to increase so much. So much. It's like Staples Center, but it's not like now it's crypto.com as a center, but Staples Center, they created a brand because of that as well. And SoFi is just, they're in an industry that's in its infancy with what they're doing with the banking industry. So I honestly think that fintech, when it does explode, it's going to make a ton of us a lot of money. I agree with Robbie.
Yeah. And the only thing to touch on, Ravi, what you're saying about, I actually had that same mentality about a hostile takeover, but someone informed me that since it's not that easy with a chartered bank, I think you have to get pre-approval to do that, which kind of defeats the purpose of more of a hostile takeover, just more of a spontaneous thing. But that's what someone informed me. I was under the impression that it would, but it makes sense that someone like Elon can't just come on and own a bank now too. Yeah. I'm sure if he really wanted to, he would.
I mean, that was one of the biggest reasons on why the bank charter was such big news. And we were $15 to $17 at that range. To be here now, it's just so hard to see like how it even went this low.
Yeah, and even Simba, he just sent me on Twitter the breakdown of the chart. Yeah, everything is oversold. Like RSI is so low. Like momentum. The momentum, although, was fairly positive. I'll just show you my chart just so you guys can kind of follow along. So some of the actual good indicators, stochastic momentum, you can see number of buyers, that shows retail presence basically. RSI is at 30, extremely oversold. On the technicals, we actually outside the boiling band, so 9 times out of 10, unless there's like a justifiable reason, we bounce back in. So even the technicals are showing and all pointing to a lot of exciting things in SoFi's future. Just want to look at one thing as well. I haven't really looked at this, if it'll load. Vortex seems to be finicky sometimes, but I want to look at options activity. But while that loads, I'll let you take over bullish mindset. And actually,
what were you saying?
On a side note, here is Bullish Mindset's YouTube as well. Pop over there, take a look, and subscribe.
Yeah.
Simba, I completely agree. Oh, yeah, go ahead.
No, I'm doing a $500 giveaway on there. So you guys just got to comment below, subscribe and comment on one of the videos that is over there, and you could be entered in for $500. It's just going to be a subscriber. I talk about Mr. Beast, but I want to be the Mr. Beast of financial content over here. So if you guys just want to click it, go ahead. It's free, obviously, and you can make some money. But SoFi is one of those companies that I love. Oh my God, it's so nice. It's such a great company.
Even today was a little bit abnormal for options activity. It's weird to see. I think people just don't know where it's going. Like I think today was a very psychological day for a lot of investors. Like seeing SoFi down as much as it was, it's hard.
Yeah, I lost a ton of money on my long term or my leaps for SoFi. The implied volatility got crushed, but I'm not really worried. I mean, it's at the end of the day, options are very, very tricky. So,
is Anthony going on CNBC tomorrow?
I wouldn't be surprised. That guy never sleeps.
Yeah, Ravi, I would not want to be a short going into the earnings.
And it was because of an accidental earnings release, which they won. Back-to-back wins for them. So it's just like, what is going to... And every single time you think a company is going to go up in this market, it just continues to go down. It just doesn't make any sense. This is not how the market is going to be for long.
Yeah.
It's not.
Yeah, it'll cycle back into growth, and I think it's just a lot of fear. Obviously, the buying power has been kind of reduced a little bit over the last little bit as Feds have been kind of manipulating and just taking advantage of this, having us on edge. But yeah, it's going to be exciting though. But on a side note, I appreciate all of you guys popping in. It was a very fun time to go through all this with you guys. Making sure you guys hit that thumbs up, subscribe. It helps push out a lot of SoFi content and things like that. Like I put in the chat as well, pop over to obviously Bullish Mindset, subscribe, and all that fun jazz. But with all that, I'll cap it all off so we can all go have a drink, a successful drink. And I think it's a good way to end the evening is have a good earnings. But Bullish Mindset, I appreciate you popping on and joining me.
Thank you so much. Yeah, I'm going to be talking about SoFi a little later today, but thank you.
Cool. Thanks, guys. Thanks for joining. You guys have a good night.